Welcome to the AICA conference in downtown Manhattan. I'm Jane King, and with me is Paul Dunn, the Executive Vice President of BlueRock Capital Markets.
Pleased to be here.
Great to be here with you. Explain what you do and what BlueRock does.
So I've been with BlueRock for 12 years. I'm responsible in the broadest sense for compliance, administration of our activities, and the distribution team, which entitles about 60 folks throughout our organization.
And BlueRock does?
BlueRock is a 22-year-old firm based here in Manhattan, although I'm based in California. But BlueRock essentially is looking for investment opportunities to provide to advisors and their clients that provide high return at lower risk. We call it asymmetric returns. So if you invest in stocks and bonds, you expect a low return at low risk, and stocks higher return at high risk, and so that's proportional. We're looking for disproportional returns because we can find that in private investment strategies like owning real estate or owning senior secured notes borrowed by the major lenders in the marketplace.
Okay, so let's start with real estate. What do you see? It feels like that's been, we've seen interest rates go up. I'm sure that's had an impact. What are you seeing in that industry right now?
Yeah, so our fund, again, is 11 years old. As I was mentioning earlier, we have the of all mutual funds in America, we have the highest risk-adjusted return of every mutual fund that's out there over the whole period. Now, in the current marketplace, what we see is as interest rates have gone up, there's very few transactions that are going on, and it's becoming more expensive for owners or potential owners to buy with the higher interest rates. So the marketplace has dropped a bit. But the rents are continuing to decline. And so as soon as the interest rates plateau, we expect a strong recovery in the marketplace. And that's been a case in institutional real estate. If you look at the 45 years of experience in institutional real estate, there's been now 3 periods of downturn, including this current one, this past year and a half. But there's been 12 years of steady growth, 13 years of steady growth, and then 12 years more of steady growth. So the supply and demand tends to cure some of the ills that occur short term or the interest rate vulnerability that we currently have.
Yeah. Now, are these office buildings, residential? I mean,
in our core portfolio, we own 7,600 properties. And they are 40% of it's industrial. We're very bullish about where that's going with the continuing expansion of e-commerce. 35% of the portfolio is multifamily. The housing crisis continues here in America, and so that's a robust. The significant portions in life science projects. Some people think of that as office buildings, but it's really very different because you need different capacities for all the equipment. Less than 6% is in office, less than 1% is in retail. Those aren't areas that are attractive right now. But the good part is that as over the years those areas become more attractive, we've got the ability to rotate the portfolio in favor of wherever the market's going to take us.
Interesting. Has the work from home had any impact on office buildings?
You see a tremendous amount of media coverage about, first thing you see is commercial real estate. But when you dig down, you see it's the office market. The rest of the markets are healthy and in some cases even robust. So people just get distracted by the media on office. And clearly office is struggling and it will continue to be challenged for the next several years as we go along here. In our case, it's only a small sliver of the portfolio and it's not really driving return or risk in any way, shape, or form. But in the broader context, as we sit here in Manhattan, some of the brand new buildings are doing extraordinarily well. A lot of the older properties are really struggling and will continue to do so for a while.
What about geographically? Are you seeing different parts of the country with better growth than others?
That's a great question. The answer is twofold. Number one is everybody's been focusing on the Sun Belt because of the population growth, but so have developers, and they've come into that market. And in a few cases like Nashville, for 2 years ago, they overbuilt that market a little bit. So you have to be. There's no one Band-Aid. In some cases, apartments are terrific, and warehouses are not in a specific sector. So you have to be very specific as to what neighborhood you're in, what kind of property you're in, how much you're going to pay for it, and to have a broader commentary. It really defeats the nuance that's part of this the business today.
That's where the hard work and the research comes in.
And that's where the returns come in, too.
Yeah.
I mean, the best managers tend to be the ones that do the deepest amount of research and understand their markets the best.
Now let's talk about the senior notes part of the business. So explain that and tell me what you're seeing in that area, especially with the interest rate situation.
Yeah, it's been a really fun experiment over the last year and a half as we introduced the fund into a marketplace where interest rates were climbing, et cetera. So a senior secured note essentially is, let's take one note and say it's Dell or United Airlines or whatever, and they will pledge specific assets behind that note. So you are what's called the capital stack, and all the risk positions that exist in a corporate financial structure. The senior secured note is the most secure because you've got specific collateral. If the company fails, there's things that you as the lender can reach to. Now, so we've got several thousand of those notes in the portfolio. And as interest rates have gone up, because those notes also are pegged to the current interest rate, as interest rates have climbed, so has the distributions that we've received for it. So, in point of fact, a month and a half ago, we changed our distribution rate and increased it to 11% per year. And we're over and above that, we're hoping to get also some growth in the NAV. So you've got an attractive yield in a very secure position. And again, that's that anomaly between risk and reward that you can't find in the public markets, but you can find over here in the private placement segments.
Yeah. So finally, just is there anything you're seeing in the senior note market or the real estate market that may give an outlook on the economy as we head into 2024?
Yeah, we spend a lot of time thinking about where interest rates are going to go. And we're very confident that we're either at or the plateau of interest rates. What is it? Over 53% of the investment market believes that by March, the Fed will start dropping rates. And over 90%, I think, if I read it right, think that's going to occur by July. And that will start boosting the economy again. Lower interest rates give borrowers the ability to grow and expand, et cetera. So, we don't see a recession, on the horizon. What we do see is a relaxing of these higher interest rates that are meeting the goal of stifling the economy. I don't know if you saw the inflation numbers yesterday, less than 3%. Okay, now we're starting to get where everybody wants to be, and now we can start thinking about what's the next step, and that's very likely to be lower rates early to mid next year.
Yeah. Okay, Paul, thank you so much.
Jane, nice to visit with you. Thanks so much.